Procter & Gamble out with first quarter results for 2026. Earnings of $1.99 beat estimates of $1.90. Revenue $22.4 billion beat estimates of $22.2 billion. The company affirming its full-year guidance. Volumes were flat over the prior year. Pricing was up 1%. Joining us now with what will be, we figure, unless something changes, his last interview with us as CEO on earnings, Procter & Gamble's Jon Moeller. He is stepping down as CEO on January 1st, taking the role of executive chairman. I think he said once the Reds finally get back in the playoffs, that's going to be it. I'm going to relinquish CEO, and somehow it happened, Jon. But welcome. It's good to see you.
Good to see you. You know, it was a good quarter. It's a 40th consecutive quarter. The team has grown organic sales. We're on track for our 10th consecutive year of core earnings per share growth, and the growth is broad-based. 8 out of 10 categories held or grew sales in the quarter. 6 out of 7 regions held or grew sales. So things are going fairly well.
Yeah, initially you managed through the tariffs pretty well, but then I think, as we're looking at the shares there, off a little bit on, I guess, renewed concerns about, whether we're really finished with China in terms of negotiating, and that does matter, obviously, to some extent with Procter & Gamble. What organic sales 2%, Jon? That was what was your estimate? 1 to 3, so that's the midpoint. That's better than the last quarter, isn't it?
Our estimate on the year is 0 to 4, so it's right in the middle of that range, and that's why, as you rightly said, we're holding our guidance ranges on both the top and bottom line. It's at about the same level as it was in the prior quarter. We'll see where that heads the balance of the fiscal year. This is our first quarter reporting results, and it gets us off to a strong start.
How are you managing through things with the current environment, with tariffs, with trade tensions? I guess you're under pressure to hold down prices, but maintain margins, which a lot of companies are grappling with that, and they're not easy to do both at the same time.
Well, we've said in the past that we will have to price a little bit for some of the tariffs. That need has actually decreased, which is a good thing. And it's decreased for a couple of reasons. One, as you mentioned, holding down costs and cutting costs, which the team is doing a very good job of. Second, the rescission of the retaliatory tariffs in Canada, which were one of our bigger issues, helped a lot. And we reversed price increases that we'd taken, or we rescinded the plans to take price increases in Canada, which is a good thing for everyone. And frankly, the administration has been doing a very good job listening and trying to get to policies that make sense. And that's led to a reduction, for instance, or 0 tariffs in some cases on, for example, ingredients that we import that don't have a source of production in the U.S., primarily because of climate. So all of that has led to a better tariff environment, and there's still some things that need to settle out. India, China, we'll see what happens after the night's communication on Canada, but we're in a reasonably good place.
Even in terms of commodity costs, it's not as bad as you thought, and amazing for tariffs. Were you being just worst case scenario? We previously thought it could be $800 million headwind for fiscal 26. You cut that in half to $400 million, and then even commodity costs. What changed there? Now you cut that in half too as a headwind to $100 million from $200 million.
Well, our biggest commodity exposure is the petrocomplex. And as Becky was just updating us on the markets, oil and oil derivatives are down versus a year ago. So that's been the help on commodities. Tariffs, we actually thought when they were first implemented, it could be as much as $1.5 billion. So it's consistent with what I've said in terms of a major improvement there as the policies have become finalized and more firm.
The stock looks good today, obviously, up almost 3%. You've mentioned a couple of things that were better than expected or not as bad as anticipated. What else do you think investors or traders this morning are relieved about or looking at in the numbers? What were you most pleased with? It might be surprising to people that it was, I don't know, better than expected or not as bad as expected.
Well, the consistency of the growth, certainly, which drove a bottom line beat, I think helps a lot. The maintenance of guidance during a very, very challenging, difficult period with all the consumer uncertainty that's out there, I think gives confidence as well. But in the end, it's results which we're committed to deliver.
Resilient demand for beauty and hair care products. We get that. We understand that completely. Can you talk about China, John, and some of the moves you've made over there? I saw headlines about diapers. I guess, is that baby diapers or across the board?
Baby diapers. China's going actually fairly well. It's a difficult market environment. But we were up in mainland China 6% on the quarter. We were up in Greater China, including Taiwan and Hong Kong, 5% for the quarter, with some real encouraging signs relative to response to innovation. You mentioned diapers, which were up double digits. SK2 was also up double digits. We grew in the majority of our categories in China for the quarter, and the growth was sequentially higher than it has been the last 4 quarters. It's been improving every quarter. Still tough, still very exciting mid and long-term prospects, and we're glad to see that business bouncing back to growth.